Welcome back. Well, let's turn our attention to OneSource Specialty Pharma. The stock has been a little bit under pressure in the last 1 month or so. The GLP-1 demand is expected to be a big growth driver for the company. Also, they plan to double their revenues, improve their margins in the next few years. To discuss this, the outlook in terms of growth, we're joined by Mr. Neeraj Sharma, the CEO and the Managing Director at the company. Hi, Mr. Sharma. Good morning, and thanks a lot for joining in. I recall when you joined us the last time around, you told us have some patience, wait for the results, and then we'll talk more in detail. So that's the opportunity now. The EBITDA number has been improving on a quarterly basis. So quarter four, do you appear that you're on track to do around $20 million approximately? And in the next 3 years, do you see that annual EBITDA number move to the vicinity of around $130 million? By FY 27-28, should that be the target?
Yes, indeed. So as we have said, as in this current fourth quarter, yes, we have given a guidance of in excess of 20 million our exit run rate, and in the next 3 to 4 years, we have said we'll be a 400 million revenue company with a 40% EBITDA margin, and a lot of it is driven by our drug device combination biologics business, which is a very strong revenue and EBITDA driver going forward for us.
So just extrapolating that number, $400 million of revenue with 40% margins means you'll do around $160 million of EBITDA by FY 28. Bang on?
That's it. Yeah, that's what we have said. In the next 2 to 4 years, that's exactly what we are aiming to do.
Okay, all right. Let's talk about capacity then. Could you tell us what is your current capacity? I believe you're increasing capacity as well. So what is the total capex you're going to be incurring? Oopsie. Okay, all right. I think we'll wait by, to get the management back. But as Mr. Sharma says, currently they're doing a quarterly run rate of little around 15 to around $18 million approximately. That number will move to around $20 million in quarter four. And in the next 3 years, that run rate on a quarterly basis from $20 million in quarter four, the quarterly run rate will move to around $40 million. All of this in the next 3 years or so. So we'll wait by for the management to join back in. But by the way, Mr. Sharma is back with us. Mr. Sharma, you were telling us about your capacity addition plans. Current capacity, where is it headed? And what is the capex plan?
Yeah, so the current capacity, we are at 40 million cartridges, which is, as I said, among the highest in the industry today. And we are actually going to take it to anywhere, excess of 200 million cartridges. And this will be over next 3 to 4 years. And in fact, to achieve that, we have already said that we will be investing about $100 million in new capex in this time frame. And significant part of this new capex will be on the cartridges and the drug device combination expansion.
Okay, let's get to funding of that. And could you tell us what is your current net debt number? Because if I look at the interest cost, for the past quarter is around 46 crores on a quarterly basis. So if I extrapolate that number, it'll come to in a vicinity of around 180 to around 200 crores of interest costs in an annual basis. What does this mean about your net debt currently? And given that you have a capex plan of around $100 million, where is this number headed?
Sure. Actually, if you saw that we have actually significantly reduced our net debt, we brought it down by half, almost from 140 odd million to 70 million end of the last quarter, which is quarter ending December. And, and we expect, because as I mentioned to you, the kind of EBITDA numbers which we are already generating and, anticipate to generate over the next 3 to 4 years, we expect most of this capex will be through our self-accruals already. The cash we'll be generating ourselves. And there's also customers who are participating in our capex program. So from a debt point of view, we have said, we are ending this year less than 1 time, debt to EBITDA. And we will actually be doing, we are going to be a net debt-free company in the next 3 to 4 years.
All right. So what does it mean in terms of interest costs, sir? Because, as you're saying that the net debt number has come down by half, but if I look at your quarterly run rate in terms of the interest cost, that's still at around 46 crores. So
we just to let you know, we have significantly reduced that in the third quarter. You saw that we had raised almost $100 million of primary investment before our listing. And we have used a significant part of that to reduce and retire our high-cost debts. So therefore, going forward, you will see our debt servicing cost coming down quite dramatically.
So on a quarterly basis, it comes down, say, to around 20 crores per quarter. Should that be the run rate we should look like in terms of interest costs?
So I don't have the exact interest cost number, but I said the total debt has come down by half. So we expect the interest cost. In fact, the interest cost will come down lower because simply because our debt servicing percentage also is coming down. Especially you would have seen our ratings have gone up quite significantly by rating agencies. So all that is going to have a positive impact on our debt servicing.
Okay, all right. Final question before we let you go. GLP-1 is expected to be a big growth driver for you. And you've indicated that you have got a fair bit of inquiries as well. What about conversion of these kind of inquiries into business, revenue potential, and from which geographies are you seeing higher traction?
So GLP-1, seriously, we were the pioneers as CDMO in this area, and we still feel we are, from a CDMO space, a very, very significant player. In fact, we already have, 20 plus customers in this area, and these customers are the global who's who in the generic space. So we will be a very significant player in this market as the market forms. We already are. Our first customers are launching liraglutide in the major markets this year, and when semaglutide, which is the largest GLP-1, which comes off patent in key markets like Canada, Brazil, starting 2026, we will continue to expand, and our revenues will continue to show that. So it's a very important drug, and OneSource will be a very significant player in the GLP as the generic market starts forming.
All right, we'll chat more. Thank you very much for coming on the program, sir. Appreciate your time here on CNBC TV18. Thanks indeed.